The US consumer is financially strained. New home prices are collapsing, down 18% year over year, and the month supply is shifting. There is a notable decline in prices, which raises concerns about a housing market crash. This will be a larger collapse than the Great Recession, as the US housing market is currently one of the least affordable of all time. The Federal Reserve's tightening campaign and quantitative tightening have led to a rapid increase in mortgage rates. It has undergone a tightening campaign over the past 19 months, raising the overnight rate by 500 basis points. This is the quickest hiking campaign ever which has been implemented, accompanied by quantitative tightening, where it burns $15 to $20 billion per month in mortgages off their balance sheet. This decision has led to a surplus of supply in the mortgage-backed securities market, with mortgages floating that big money investors have struggled to absorb. The lack of investors to absorb mortgages has led lenders to increase risk premiums, which are impacting home sales and demand. These actions, coupled with various deflationary indicators like falling prices in housing, used cars, airline fares and commodities, raise questions about the economic trajectory. The efforts to attract buyers are putting upward pressure on yields. Its primary focus is on achieving the mandate, which includes maintaining maximum employment and controlling inflation. The Fed is desperate to find a balance in unemployment rates to meet its goals. It can intentionally induce higher unemployment to achieve its inflation and employment targets. It is tightening the credit and disruptions in commercial real estate valuations. Wells Fargo and Bank of America have warned about the risk of recession in the housing market due to higher mortgage rates. The Federal Reserve responded by raising interest rates, causing this hike to surge to combat inflation, which led to a cooling of demand. The 8% rates are not high historically, but they have significantly impacted housing affordability. The rise has outpaced the growth in median family income. A joint statement is issued from industry associations, including the Mortgage Bankers Association, urging the Federal Reserve to reconsider raising rates to support the housing market. The tug of war is going on between low inventories boosting prices and higher mortgage rates reducing them. The inventories of new homes are edging higher, which will continue to dampen demand. The Fed easing cycle and a decline in mortgage rates will alleviate downward pressure on home prices. So it is reluctant to cut rates due to fears of exacerbating inflationary pressures. Its reverse repo facility collapses, which signals a liquidity crisis, and this decline will lead to higher bond yields as demand shifts towards increased returns. The value of the US dollar is falling due to investor expectations of rate cuts by the Federal Reserve, while the issuance of bonds is keeping yields elevated. The Fed is needed to navigate these challenges. If they decide to cut annual percentage rates to boost the economy and jobs, it will exacerbate inflation, creating a complex policy dilemma. A softer labor market and rising unemployment will lead to a further increase in inventory levels. It creates pressure on developers to sell homes, which results in further price reductions. The changes in levels, mortgage rates, and demand will impact prices in the coming months. The United States is officially in a default cycle as its corporate and commercial real estate loan maturities start to impact borrowers. This trend is expected to continue through 2028. Many corporations and real estate investors obtained loans at low annual percentage rates. As these loans mature, borrowers are faced with the choice of either paying them off in full or refinancing at significantly far up interest rates of about 9 to 12%. The United States is currently facing a significant shortage of homes, with a deficit of at least 4 million units, and 2 million of those are desperately needed as affordable housing options. The middle class is at a crossroads, facing difficulties with skyrocketing mortgage rates and the increasing wealth gap. 8.53 million of households are currently living in inadequate conditions without government housing assistance. The lack of affordable and safe housing is a critical challenge affecting communities across the country. A looming technological shift in the next 5 to 7 years will impact real wages, necessitating preparation for inevitable changes. Housing security is important due to its direct impact on health and well-being. There is a chance of a domino effect of financial ruin, so individuals should secure stable business or employment opportunities for security and property purchasing ability. There is a risk of significant property turnover, with institutional investors eager to capitalize on the situation. This will lead to a shift in ownership from small investors to large corporations, consolidating wealth and making it tough for most people to purchase property, as they are eyeing almost half of all single-family rentals in the next 6 years, which will exacerbate the housing crisis. As a result, the rents will be increased and housing options for families will be limited, which is going to push many to the brink of homelessness. Inflation is fueled by extensive money printing in the last couple of years, has led to soaring prices. The impact of rising borrowing rates on various sectors, especially as corporate debts will readjust in 2024 and 2025. The challenges will be beyond what has been experienced so far. The lofty yield corporate bonds and leveraged loans are categorized as riskier investments. Defaults are expected in this segment, leading to financial distress. The former's loan maturities in 2024 will double, followed by a tripling in 2025 and continuing through 2028. The anticipation is that many of these companies will face challenges, ultimately moving towards bankruptcies. 11 million workers are employed by companies in the inflated yield index, while 8 million are employed by those in the leveraged loan index. This suggests that around 19 million employees are at risk of losing their jobs. The financial distress in corporations causes a spike in unemployment. There are signs of trouble in job growth, which has been slowing, and wage growth is cooling down. Industries like trucking, real estate, and tech are experiencing problems. The government and the Federal Reserve initially touted the strong economy, growing faster than expected. However, the concern arises because rapid growth can worsen inflation as people spend more money. A 5.6% decline in new home sales in October is the result of high mortgage rates and weakened demand. There is a significant downturn as builders are aggressively cutting prices and offering extremely low mortgage rates, which is causing distress in markets where existing sellers struggle to compete. The affordability gap between new and existing homes is narrowing, as the median sale price of a new home is only 4% way up than that of an existing home, which is a historically low premium. This indicates a need for a broader decline in prices and a decrease in mortgage rates to 5 or 6% to entice homebuyers back. Certain areas like Utah, Idaho, Colorado, Texas, and Florida are witnessing the most significant impact on prices. Conversely, areas with limited builder activity such as Michigan, Illinois, Missouri, or West Virginia are less affected. The builder-induced price crash is affecting not only affordable housing, but also luxury markets, as million-dollar properties are experiencing substantial price cuts. Their stock prices are towering, which is attributed to reduced construction costs, especially the decline in lumber prices. Rising living costs make it challenging for small investors to make all cash payments for properties. Most buyers can only afford a modest down payment, which causes increased competition, skyrocketing property prices, and limited options for buyers. Home builders are adopting several strategies in difficult real estate conditions. They are using rate buy-downs to make new houses more attractive for buyers. This involves temporarily lowering mortgage annual percentage rates to encourage sales. They are opting to sell smaller houses, presumably to cater to the budget-conscious people. They are using cheaper materials for appliances, floors, countertops, and other features. This is done to reduce the overall cost and make the homes more affordable. They are changing the size or layout of the homes to meet the changing demands. These strategies reflect the problems faced by home builders in selling properties in the current economic climate, as they are focusing on affordability concerns of buyers. The rising annual percentage rates lead to increased costs on loans, which puts pressure on excess spending. There is a correlation between home prices and supply and demand in real estate. The 8% peak in the 30-year fixed-rate mortgage is alarming and discouraging home buyers. The U.S. consumer, who represents 68% of GDP, is squeezing spending. The United States economy is still resilient to endless government spending of about $6.13 trillion in 2023. It is being kept afloat solely through borrowing, and any attempt to stop deficit spending will lead to a deep recession. The excessive borrowing at elevated interest rates creates a cycle which will lead to an uncontrollable deficit situation. Global demand is contracting across Europe, China, and Japan. The US is not immune to it, so domestic demand is expected to drop. The reduction in liquidity is seen as a risk to the financial system. The rising rates make everything more expensive, putting pressure on excess spending. The predictions about future mortgage rate movements are uncertain. The delicate balance between stimulating the economy and controlling inflation is narrowing. The housing dynamics are influenced by the fundamental principle of supply and demand. Currently, the unaffordability level is high due to soaring prices. It's essential to understand that seasonal fluctuations impact prices like they peak in the beginning of the year into summer and dip afterward. Institutional buyers and many first-time home buyers are currently less active due to previous conditions. However, baby boomers and high salary earners constitute a significant portion of current purchasers. Projections for 2024 vary among economists. Some predict modest price increases, while others suggest slight declines. The expected decline in transactions is considered a key indicator. Mortgage interest rates, predicted to decrease in 2024, will influence dynamics. The interplay between supply, demand, and external factors like interest rates shapes the housing market. This particular sector is undergoing a complex shift, marked by builder-initiated price cuts, affordability challenges, and deflationary signals. Homebuyers and investors are advised to monitor local market data and keep an eye on factors like housing unit growth rates, overvaluation, property tax rates, and price cut trends for informed decision-making. Savvy investors can navigate both rising and falling interest rate environments by capitalizing on opportunities. Real estate is connected to broader concerns because if interest rates don't come down, then the pressure on the real estate will persist, which will ultimately lead to financial downturn. Economic literacy and responsible spending during the holiday season are very important steps now. Comment down your thoughts. And if you like this video, please consider liking, subscribing, and sharing the video. Thanks for watching, and we'll see you in the next one.